It's UBBOptionMillionaires.com. After the closing bell on this March 29, 2016, the markets roared higher today. It all started at about noontime when great economic data was released, coupled with some massive, tremendously bullish earnings reports. Oh, wait, no, it wasn't. Apparently, some economic folk over at the Federal Reserve were meeting at some country club, hitting golf balls, and they decided to release this speech that said, hey, you know what? Are we going to raise interest rates? And they were like, not today. And S&P 500 futures spiked as if there were no sellers left in the market. Or maybe they're on vacation in Disney. It is spring break after all. The kids are off from school. What better time to ramp the market up and the NASDAQ up to highs for the year when nobody's around? Hello, ho, ho. Yesterday there was 4 shares traded on the S&P 500 ETF to spiders. Today, 7.5 shares, give or take. So you look, S&P 500 futures. I was talking about this yesterday. What a difference one day makes, folks. I was looking at this pattern here. I keep pointing this pattern out, saying, hey, you are here, and comparing it to the rally that we saw off the lows in February. And it's working almost to perfection. So here we are topping out. It's seemingly topping out. It seemed like we were going to start pulling back like we did back after the November 1st high started to roll over. I thought that's what was going to happen. And no! Federal Reserve, again, meeting today. It's not economic data, folks. It's not earnings reports, GDP, none of that. Simple speak over at the Federal Reserve, talking the markets high. Again, we go back to the old adage, do not fight the Federal Reserve or every other central bank in this world. I talked about in the chat room briefly today. I say, you know what? There's 2 things that are going to happen this year in 2016. I still believe that despite the rally that we've seen today and off the lows in February, is that the market is going to ultimately come back, retest, and break the lows from earlier this year, which seemingly seems like 6 to 9 months ago. No, it was 8 weeks ago. And also, central banks around the world, including the Federal Reserve, will do everything within their power to avert said pullback. So we'll see if that does indeed happen, come to fruition. Right now, it does not look like it. Again, this pattern is not playing out. I was looking for a pullback and ultimately a move down to new lows within the next couple months. Not sure that's going to be the case now as we've broken above it. You can see this move to the upside. Possibly, again, maybe testing new record highs. I mean, that would be something 8 weeks ago nobody was talking about. And if you look at the bearish percentage over at StockTwits was something like 24%. Never saw it. Bullish, excuse me, 76% bears, 24% bulls. Never seen it that low before. That was down here. And we were up here, and I just saw it yesterday, 30%. So it's really a lot of bearishness still out there in the marketplace. Speaking of bearish, despite the rally here for the stock market, Federal Reserve talking up the markets, crude oil continues to pull back. And you can see this move. Is this just a gap fill here over the short term? See the gap fill? Hello, gap. We are filled here. Or if you look at the long-term chart I continue to talk about, is this just a bounce? Hello. And if you look at the move we've had even off the lows, looks very small in the face of this massive crash that we've seen for crude oil. If you look, we had a bounce again, started 2015. A little more duration to it than this one, and a little more height and depth to it. Before pulling back. So we up at this area right here, and we're going to start pull back into the mid-20s. Not hearing that either. Just like you're not hearing new record highs or the move off the lows that we saw in February bring us up there. You're not hearing that with crude oil. Hello, crude oil. And up, but on the flip side, the U.S. dollar index. Not only did the Federal Reserve talk up equities, talk down the dollar index, but still in a consolidation phase here after hitting the triple digits for the first time in 15 years. And if you look back just over the last year, continue to remain support here at about 93.50. This was the crash in August. The U.S. dollar index sold down. But you can see it's been a stair-stepping pattern to the down. And heading into 2016, I thought the U.S. dollar index would rally pretty good, and I still think it will. And that ultimately would be a headwind for corporate earnings. So that's something to keep in mind going forward. But the Federal Reserve doing a great job talking down the U.S. dollar. Meanwhile, every other central bank in the world wants to devalue their currency as well. So that's the next world war, is a currency war, throwing each other's money around to devalue it. But if you look as a bear out there in this marketplace with the U.S. dollar index falling, equities rallying, seemingly look at the VIX. I mean, the VIX just got clobbered today, down almost 10%. The VXX continues to be a great, and I talked about this from a short-term duration intraday. When the VXX doesn't move significantly higher, we've seen a meltdown for the market. Call a meltdown here. 2.2% is what we were down this morning. VXX was kind of shrugging its shoulders, was not moving as you would expect it to. There's no fear in the market, and consequently, we saw the dip get bought up into lunchtime, and then Janet Yellen came out and said, "Not today." If you look, the VIX beaten down, and I talked about this 30 level. Hello, 30, goodbye, 30. We're down over 50% since that level was hit. And we're coming, we bring a trend line across. We're back near the lows that we saw after the crash back in August. And we see a nice move off those lows heading into November and ultimately the start of the year. So it's just something to keep an eye on. If we continue to break down, we're going to come back, what, to the 1177 lows that we saw in July of last year. And if you look, these lows 4 weeks later, we're setting up for this big market crash. So the complacency is starting to set in again in this market. It doesn't feel like it's ever going to go down again. Every dip gets bought. So we're back in that phase. Do you ride the wave? And here's the VXX. Look at that, under 18. And if you draw a trend line across, we're almost through the lows that we saw again off the spike up after the crash in August. So it is. It's like, is this a market that I want to be buying here or selling? So again, if you're a bear in this market, you want to look at the IWM, the small caps. You're like, all right, there's one thing I can hold on to. So the small caps, after their record high, we have this trend line, this resistance. Maybe this rally will come up to 112. This is going to be the key line in the sand. I think overall for the markets, the IWM small caps are a great indicator of what the market's going to do in the short to medium term. They call it the canary in the coal mine when the small caps start to pull back. So we'll see if it's the canary in the coal mine or if it's the canary in the bird feed store and all the bird feed's gone. It's just this big fat bird that's going to rocket up to new record highs and then just crash and die. So we're going to watch that 112, 113 level for the IWM, see if this rally stops there, pulls back. Also, something else, if you're a bear out there, XLF, financials, although popped into positive territory today. Look at this. We have this wonderful, beautiful trend, Abenomics. This is the Abenomics low here for financials. Look at the rally since Abe Shinzo over in Japan decided to devalue the yen. And if you look, the move for the financials to this move up into the highs 2015. But look, the trend is changing. The winds have changed. Starting to show weakness here for financials. And so today, if you look at it, I mean, everything bounced off the lows. I mean, if you didn't hold on to your chair today, your chair would have been bought up. I mean, this is buy everything. Negative interest rates. This is a great, great policy from the central banks around the world. Something the historians will look back on and just, wow, marvel. Say, hey, we could just give money away for free and save the world. Low interest rates forever. You know, that's going to be the motto. It's like, oh, we don't need an economy. We could just have central banks hand out money for free. So if you look, the trend is to the downside, XLF. Also look at energy. The energy ETF, you can see not so strong today. Not so strong. I will talk up everything else, but not energy, because they're all going bankrupt. No, I don't know. I'm getting crazy. A little too much sugar. If you look at the trend line here, came up to it, starting to pull back. So I think if you're looking for a put position, something to trade for downside, energy, break under 60, that'll be a nice move down to this 50 level. Remember, I talked about it heading into 2016. Heading to 50, it actually went to 49.92 or something like that, XLE, before it started to bounce. Also, some of these other stocks that have been just on an absolute tear. Look at Caterpillar. And you can bring up the longer term chart here. It's 10-year monthly, and you can see this level that is broken back above as it had back in 2011. Are we going to head back up to record highs here for Caterpillar? I am not so sure. But if you look, the action off the lows again, we're not seeing that big, huge candle to the upside, but certainly, what has it been? About 56 to 76. That's just an amazing, amazing move there. 30-some+% for Caterpillar. Also, John Deere making a big move. Some other names, though, looking pretty weak, and I like Boeing over 130. We'll see if you can hold on to that. So if you're kind of bullish on this market still, a stock like Boeing could have some upside potential to it. And you can see this nice flagging pattern here. Possible move up to 140. So if this bull market continues, quote unquote bull market, we are now in a bull market for 8 weeks removed from the Great Depression. Disney, on the flip side, you know, has not been able to get back over that 100 level. And if you look, I don't know what this thing's doing here, but if you look, this action here, possible double top, and we're starting to roll over here. So Disney, you know, we had Star Wars, Zootopia. Nothing seems to lift the stock. ESPN's not doing so good after they put the stupid strike zone up for baseball. I can't watch that crap anymore. A couple other charts to look at here. Chipotle Mexican Grill. Breaking down, folks. Break down. You draw a trend line across. Looks like a wonderful flagging pattern. We're going to break to the downside. Also looking at some other stocks here. How about Twitter? Haven't talked about Twitter in quite a long time. Kind of meandering out, and you look at the volume, just petering out here. to me. Is that exhaustion? Does that mean the sellers are done? That's a good possibility here. And if you look at some of the social media stocks really rip roaring to the upside, why not Twitter? I mean, now it's at 15.97. Remember, people were talking about the company getting bought out when it was 37, 38, 40, 41, 41. Do I have $42 a share? Now it's at 16. What's the market cap? About 140 tweets? I don't even know, but it's worth a look here at 15.97. I was looking to get in some calls yesterday and or today. Did not. Regretting the decision, but we know Twitter can make an impressive move here. Look at the action just intraday off the lows. Wonderful consolidation, move up, consolidation. Looking for that move. It gets over 16. Guess what? We can start looking at 17. And once it gets over 17, maybe 18. And then after 18, 19. And then we're at 20. Wow. Woo! You'll be here, optionmillionaires.com. Hope everyone has a great evening. See you in the chat room tomorrow. Tomorrow is just a day away. Tomorrow. Take care.